Hey everyone, welcome to the channel. Today we're diving into a topic that can seem a bit intimidating at first, but can really level up your investing game: options trading. If you've ever wondered what options are, how they work, and how people use them to make money or hedge their investments, then this video is for you. We're going to cover everything from the basics of options to advanced strategies, and I'll give you real-life examples along the way. Grab a notebook, because by the end of this video, you'll have a deep understanding of options trading. Let's get started. First things first, what exactly is an option? Simply put, an option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price, called the strike price, before a specific date, known as the expiration date. There are two main types of options: call options and put options. Let's break these down in detail. A call option gives you the right to buy a stock at the strike price before the expiration date. You typically buy calls when you think a stock is going to go up. For example, let's say you buy a call option on a stock with a strike price of $50 and it's currently trading at $45. If the stock rises to $60 before the expiration date, you can buy the stock at $50, sell it for $60, and make a $10 profit per share, minus the premium you paid for the option. But if the stock never rises above the $50 strike price, your call option expires worthless, and you lose the premium you paid for the contract. That's why it's important to consider both the upside potential and the downside risk. Now let's talk about put options. A put gives you the right to sell a stock at a specific price before the expiration date. Traders usually buy puts when they believe a stock will go down in value. For example, you buy a put option with a strike price of $50, but the stock is currently trading at $55. If the stock price drops to $40, you can sell it at the strike price of $50, netting a $10 per share profit, minus the premium. Just like with calls, if the stock price doesn't drop below the strike price, the put option expires worthless, and you lose the premium. So, what exactly is this premium we keep talking about? It's essentially the price you pay to buy the option contract, and it's influenced by several factors. First, time until expiration. The more time left on the contract, the higher the premium. Why? Because the stock has more time to move in your favor. Second, volatility. If the stock is highly volatile, premiums tend to be higher, because there's a greater chance the stock could hit the strike price. Lastly, the current stock price. The closer the stock price is to the strike price, the higher the premium, because the option is more likely to become profitable. Now let's talk about the two main reasons traders use options: speculation and hedging. Speculation is when you buy options to bet on the future direction of a stock. For example, buying call options if you think a stock will go up, or put options if you think it will go down. This is a high-risk, high-reward strategy. On the other hand, hedging is a way to protect your portfolio from potential losses. For example, if you own a stock and you're worried it might drop in price, you can buy a put option to limit your downside risk. Now that we've covered the basics, let's move on to some popular options trading strategies, starting with the simpler ones and then moving into more advanced techniques. A covered call is a strategy where you already own a stock and you sell a call option against it. This allows you to collect the premium, but if the stock price rises above the strike price, you may have to sell your shares. This is a great way to generate extra income from stocks you already own, especially in a flat or slowly rising market. A protective put is like buying insurance for your stock. You own the stock, but you're worried it might drop, so you buy a put option. If the stock falls, the put increases in value, offsetting your losses. This strategy is useful for long-term investors who want to protect their portfolio without selling their stocks. Next up is the iron condor, which is a bit more advanced. This strategy involves selling both a call and a put at different strike prices, creating a range where you hope the stock will stay. The idea here is to profit from low volatility. You collect premiums from both the call and the put, and as long as the stock stays within a certain range, you keep the profit. A straddle is a bet on volatility. You buy both a call and a put at the same strike price. If the stock moves significantly in either direction, you stand to profit. This is a good strategy when you expect a big price movement, but you're not sure which way the stock will go, such as before an earnings report. Options traders often talk about the Greeks, which measure different factors that affect the price of an option. Let's briefly touch on the most important ones. Delta measures how much the price of an option will change if the stock price moves by $1. A call option with a delta of 0.5 means the option price will increase by 50 cents for every $1 the stock price goes up. Theta measures time decay, how much the option price decreases as time passes. The closer the option is to expiration, the more rapidly it loses value. And Vega measures how sensitive the option is to changes in volatility. High volatility increases an option's price, and low volatility decreases it. As you can see, options can be a powerful tool, but they're also risky. You can lose your entire premium if the trade doesn't go your way. That's why it's important to start small and never risk more than you're willing to lose. I highly recommend practicing with a paper trading account before using real money. It allows you to test strategies and get comfortable with how options work without putting your capital at risk. So that's a comprehensive overview of options trading. I hope this video helped demystify some of the key concepts and strategies. Remember, options can be a great way to hedge your portfolio or speculate on market movements, but always make sure you understand the risks. If you found this video useful, hit the like button, and don't forget to subscribe for more finance, investing, and trading tips. See you in the next video.